Hello guys, and welcome to this next part in our teaching series. This is King Kelks as usual, and we are going to be continuing our technical analysis series. In this teaching, we are going to be going over liquidity and reference points. So let's get started. So what is liquidity? Liquidity is the sole intent behind price movements, right? So earlier in the series, specifically the first video, we talked about how liquidity refers to the activity of buying and selling, right, of a currency pair, right? So how does buying and selling take place though, right? It's with money. So in order for you to buy any particular pair or sell any particular pair after your analysis, you have to put in skin into the game, right? You have to put in your money, right? So there are hundreds of thousands, millions of people buying and selling a particular pair, right? Which means they are putting in their money. So putting it simply, liquidity is where the money is. Now, I said above here that liquidity is the sole intent behind price movements. So any move the market makes, to go above, to go down, is all to what? To run liquidity. Because the only way the price movements can keep going up or down, right? The way these market makers move price is so that they can be able to, because they trade with huge funds, really huge funds, right? So the way they can be able to enter positions and exit with profit is if they make money off other people's money, right? So as we continue to progress, you'd understand it more better. So liquidity is where the money is. Keep that in mind. Now, where do we find this liquidity we're talking about? First of all, it's important we establish that there are two types of liquidity as it relates to our teaching. We have external range liquidity and we have internal range liquidity, right? So price moves in a repetitive framework of going from one liquidity to the other. That is from external range liquidity to internal range liquidity. So typically this is what we'd like to see. We would like to see price take external range liquidity, then come back to internal range liquidity, to go for external range liquidity, then come back to internal range liquidity, right? So it's interchanging in a way. So when external range liquidity is taken, we come back to internal range liquidity. When internal range liquidity is taken, we come back to external range liquidity. So price moves in a repetitive framework, right, of going from one of these liquidity to the other. That's from external range to internal range, and from internal range to external range. Let's keep going forward. So where is this external range liquidity specifically? We have seen that we have both external range liquidity and internal range liquidity. So where is external range liquidity? External range liquidity is gotten by running through stop losses, right, of retail style traders. They have two types. So I said in the previous slide that liquidity is basically money. So how do we get this money? By running through stop losses of other traders. Because when you run through a stop loss, earlier on in the series we talked about stop losses and how stop losses is going to make sure that when price is going against your analysis, it will exit you out of the trade, but at a loss, right? Let's say you enter a position, right, that allows you to risk, let's say $10 on a particular trade, right? And so you put your stop loss at a price where it will exit you out at $10 loss. So when it exits you out, that stop loss, or on your stop loss, you have lost $10. Where does that $10 go? It's liquidity, right? For other people who are profiting from the opposite side of your trade to make money. So basically, the money you lose in your stop loss is what becomes someone else's profit. What is your profit, right? When you make it a profitable trade, that money you get from your profit is basically someone else's stop loss. Essentially, just know this, right, and you understand what we're talking about. So now this external range liquidity is gotten by running through the stops, right? That's stop losses of retail style traders. They are of two types. Buy side liquidity. This is found above or at, right? So that's by running through buy stops. What is buy stops? Buy stops means if you are selling, you expect price to go down. Okay, let me use this. So if you sell at this price, let's say this is current market price, let's say $150, right? And you're selling at this price right here, you expect it to go down. And so because you want to set your stop loss as the disciplined trader that you are, you set your stop loss at 120, right? So you're willing to risk like $30 Of course, this is not the way to price, but I'm just giving an example with $120 and $150. So let's say you're willing to risk $30 in between here and here, right? What type of stop loss do you place here? You place a buy stop because you are selling, so you're trying to stop yourself from losing more money if it decides to buy, right? So this is your stop loss essentially. So buy side liquidity is gotten when what is found above or at, right? So by running through buy stops. So let's keep going. So there are of two types: buy side liquidity, buy stops. That's by running through buy stops. This is found above or at old highs, equal or relatively equal highs, high of the week, high of the day, previous day high, or previous week high. That is buy side liquidity. I'm going to explain it further, but now keep in mind that since it's by running through buy stops, typically people put their stop losses, right? Retail traders put their stop losses above old highs, above equal or relatively equal highs, right? Above high of the week, high of the day, previous day, or week high, or structural high. That's the old highs, right? So whereas sell side liquidity is found below or at old lows, so it's basically the complement of whatever is here. Instead of old highs, sell side liquidity is found at old lows, found at equal or relatively equal low, found at low of the week, low of the day, previous day low, and previous week low. So in this case, you as a trader, you decide to buy at a particular price. So you decide to buy at a particular price, let's say over here. So you expect it to go up away from your price, but being a disciplined trader, you set a stop loss over here. What are you setting? It's a sell stop, because you're trying to stop yourself from losing money if it sells, right? So sell side liquidity is gotten by running through sell stops. Buy side liquidity is gotten by running through buy stops of traders. So buy side liquidity is found above or at old highs, equal or relatively equal highs, high of the week, high of the day, previous day high, or previous week high. So basically highs. While sell side liquidity is gotten by running through sell stops and is found below or at old lows, equal or relatively equal lows, low of the week, low of the day, previous day low, and previous week low, right? So basically lows. So let's keep going forward, shall we? So we just talked about how we find external range liquidity, right? Both buy side and sell side at old highs or lows, equal or relatively equal highs or lows, high of the week or low of the week, high of the day or low of the day, previous day high or low, previous week high or low, right? Those are the entire form of external range liquidity. So now let's look at this example over here. So do you see how you see over this high over here, there's buy stops resting above it, right? Over this high there's buy stops, over this high there's buy stops. And look at this over here. Do you see how these highs are all very relatively equal? They are all relatively equal. They are all relatively at the same price. That's what we mean by relatively equal highs. So now, what does price do? Price come and trade above it. Whenever price trades above old highs, equal highs, relatively equal highs, high of the day, previous day high, is to take buy side liquidity, right? So as we can see it over here, above highs we find buy side liquidity. While when price trades below old lows, previous day low, previous week low, equal lows, whatever, right, is to take sell side liquidity. So as you can see below this old low, what did we take? Sell side liquidity, right? So this is the basically the how price moves. Take buy side liquidity or sell side liquidity and keep going. So let me show you another example. So you see over here what happens. Price trades, we take out sell side liquidity, take out buy side liquidity, right? Keep trading, take out buy side liquidity, take out sell side liquidity, keep trading, take out another sell side liquidity, trading, sell side liquidity, another sell side liquidity, right? So now if you can remember at around the first slide, I talked about how price moves in a repetitive pattern of going from external range liquidity to what? Internal range liquidity. So do you see these price movements where price does not take out liquidity but instead it goes somewhere? That's actually the internal range liquidity, which is what we are going to be going over in the next slide. So where's internal range liquidity? Internal range liquidity is where the market makers return to pick up more orders, right? And where do we find internal range liquidity? Is at institutional reference points. Importantly, they are liquidity void, fair value gap, and order block. In this teaching, I'm going to focus on fair value gap because that is the most important right now, right? So fair value gaps are the most important internal range liquidity reference points. So now we talked about how for external range liquidity, price will go to take out money, right? To get money. So what is this internal range liquidity? This internal range liquidity is where price will return to pick up more orders. So these market makers, they will put in more positions because now more money has been gotten, right? So they will return to these reference points, right, within the range to put on more orders and open more positions of their buying and selling, and then keep going. So let's look at this. So look at this. Assuming there was an old high here, right? Price trades above it, takes out external range liquidity. Where does it return into? Internal range liquidity. So this is where the market makers will return to put on more orders, right? And then where will they go to again? External range liquidity. After taking out external range liquidity, what do we see? A return to internal range liquidity to put on more orders again. And then where do we go to next? To take out external range liquidity. We return to internal range liquidity to put on more orders. When we take out external range liquidity, we take out take out this external range liquidity here. We now return to another internal range liquidity, take out external range liquidity, right? Over here as well. Let me put this on. Over here, right? We take out another external range liquidity and return to internal range liquidity, and then come for internal range liquidity. Now, basically, what do we expect? We expect that there's also another internal range here that price will most probably return to, and then go where? To go and take out this external range liquidity over here. So as you can see, this external range liquidity is in the form of buy side in blue, buy side liquidity, buy side liquidity. Below here we see is in the form of sell side liquidity in the red, sell side liquidity in the red, right? Over here it returns to internal range liquidity. So before we go any further, I know you're asking, okay, you want to see these on the charts, and you also want to know what this fair value gap, this liquidity void, and other blocks are. So before we go any further, let me go and outline external range liquidity in the form of buy side liquidity and sell side liquidity, and then we'll now move on to internal range liquidity. So let's go. Alright, so here we are. So now if you can remember from our market structure video, we talked about how when we're in an uptrend, we keep having market structure shifts to the upside, right? In the sense that we keep going in the formation of higher highs, right? And then higher lows, right? So now whenever price takes out this higher high, what does it do? It takes out buy side liquidity, right? So as we keep forming these higher highs, we keep taking out liquidity above these old or structural highs. So whenever we take out these old highs, we're taking out what? Buy side liquidity above them. So all this is buy side. It's all buy side, right? Then over here, what do we take out? We take out sell side liquidity, right? Come take out sell side liquidity again. So just go back to the slide, right? You see old highs, what? Previous day highs, previous week highs, equal highs or relatively equal highs, right? Let me see an example of relatively equal highs over here. So see over here, can you see how these highs are relatively equal to one another? What do you see over here? Price takes it out, right? So price took out liquidity over here. So to take out liquidity, you must not see the candle body trade above these highs, right? Unlike market structure shift where it requires the entire candle body to close above the high. No, once a wick passes through. So let me make an illustration over here. So if this is the high, if this is the high over here, what do we have above here? Buy side liquidity, right? We have buy side liquidity just begging price to come take it out. So now when we return later in the future, right, we don't need this candle to close above here. Once price comes and trades even by a pip, by a single pip above, now this is very important, above. So assuming this price over here, the price of this high, assuming this price over here is 1.2000, right? That's the price of this high over here. And then this later in the future we come and we trade to 1.2001. Then price has taken out liquidity. As long as it's not 1.2000, because if it's 1.2000, what have we formed? Equal highs, which means price will return later in the future to even take that out. But if price trades above it by even a pip, right, the 4th decimal place over here, then we have taken out liquidity. We can say yes, liquidity is out, right? So whereas in the case whereby we don't take out this liquidity and price instead form equal high with that previous high, what does price do later on? Price will return to purge liquidity, to take out liquidity from that area, because now we have equal highs, just begging price to come take out liquidity. So equal highs over here, and so even when price trades by a pip, we'll have taken out liquidity above them, right? So let's return to the charts and keep searching for our external range liquidity. So why do we call it external range liquidity? Look at this. If this is a range in between here and here, from this low, because this is the lower high, right, to where this higher high, it's a range, right? So it's outside the range, right? It's either above the range or below the range. Above the range in the form of buy side liquidity, below the range in the form of sell side liquidity. That's why we call it external range liquidity, because it's on the outside, right? So we take out external range liquidity over here in the form of buy side liquidity, external range liquidity here in the form of buy side liquidity, external above those relatively equal highs, right? Then below old lows, structural lows, previous day lows, equal lows, relatively equal lows, any low that is structurally important, right, that is traded below, right, is to take out liquidity, right? So below this low, take out liquidity, right? Take out liquidity, right? Okay, now this is a very nice example to check. Look at this. What's the high of this over here? Just look at OHLC values over here. The high is 1.24465. What's the high over here? 1.244 what? 78. What does that tell you? That we have taken out liquidity, because 1.24465 is lower than 1.24478. 6578. Right? So that one was on 6, this is on 7. That's a pip above, a pip and some pippers above, right? So we took out liquidity over here, and then what do we see? We now started going forward, right? So that is external range liquidity. Now what about internal range liquidity? We said that internal range liquidity is in the form of these three main things: liquidity void, fair value gaps, and order blocks. So now what is liquidity void? Now liquidity void is a one-sided price action. Liquidity void is a one-sided price action. What does that mean? Okay, let's come over here. Do you see how from this point to this point, everything we have here is all up candles? That means all that was being offered throughout here was buy side, not sell side. So we have what they call buy side imbalance, right? Sell side inefficiency. That's the liquidity void, because all we've offered throughout here is buy side. So do you see how when price took out this external range liquidity, right? Sorry, when price took out, let's use this over here. When price took out this external range liquidity, what happens? We return to this liquidity void and then go for another external range liquidity. That's from what? External range liquidity to internal range liquidity, right? Are you beginning to see it? So let's keep marking out some liquidity voids, right? So when there's one-sided price action where there's no single interruption by the other side, so over here liquidity void, over here liquidity void, right? So it's basically saying if we are going down, every single candle is a down candle, the next one too is a down candle, right? It can be 2 candles, it can be 3 candles, it can be more, but basically having a series of uninterrupted either sell side, or let me put this over here so you can screenshot it. So liquidity void is a one-sided price action delivery. It's a one-sided price action delivery. So whether it's down candles, right, that means liquidity void of bearish side, that is side buy, that is called sell side text. That's called sell side imbalance, buy side inefficiency, right? That's because all the candles here are downside, right? So it's sell side imbalance. There's inefficient buy side price action, right? So, or side buy, while over here in a scenario whereby we have just upward price movements, price is just offering us higher prices, right? So a one-sided price delivery to the upside is what? It's going to be buy side this time around. So both are liquidity voids, right? One is to the sell side, one is to the buy side. So this time around, this is what? Let me put it down here. This is buy side imbalance and what? Sell side inefficiency, or buy side. So that's liquidity void. So typically price will want to come back into this buy side imbalance, sell side inefficiency to rebalance price, because now we have an imbalance, right? As we have said from the name. So we have an imbalance, a buy side imbalance, sell side inefficiency. So sell side was inefficient in this price action. So now we are coming back to rebalance price by providing sell side, and then after that, what do we expect? We expect that price to continue going for external range liquidity. So this is internal range over here. We have external range lying above here. So when price returns into internal range, we now go further for external range, right? Let me mark all these and bring it down in case you want to screenshot. Right, so as you can see over here, we had the liquidity void, right? We formed our range high, right? And price returned into liquidity void, in other words internal range liquidity, and then traded to buy side liquidity in the form of external range liquidity, or external range liquidity in the form of buy side liquidity. In the same way, we have sell side imbalance, buy side inefficiency, right? So we have formed our range high, our range low, and then price will return into that liquidity void, right? And now what do we have over here? We have sell side liquidity resting outside this range, right? So after price trades into this liquidity void, what do we expect? We expect to see, right, trading back and through external range liquidity, right? So as we keep forming higher highs, and higher lows, we keep having liquidity being outside the range in the form of external range liquidity, and liquidity being inside the range in the form of the reference points that the market makers will return to put on more orders, right? So now let's go on to fair value gap. Now I want to make a very important distinction between liquidity void and fair value gap. Liquidity void, right, is one-sided price delivery. So it can be multiple candles, right? It can be two candles. It can be something like this. So it can be something like this, and we have a liquidity void, right? As long as it's not being traded through by any sell-side candle, or as long as it's not being traded through by any buy-side candle, right? Why for fair value gap? What is fair value gap? Fair value gap is a 3-candle price action. So what do we mean by that? Let's get rid of all these things. Okay. So look at this. In a situation whereby we have 3 candles, right? Now we know that when one candle closes, another one opens from that place, right? And then when another one closes, another one opens from the price at which that one closes. So in a situation whereby we have wicks like this, it does not have to be wicks, just high and low of a candle, right? So it could be the body, it could be the wick, right? So when we have the high and low so when we have something like this, right, a situation whereby the wicks of these are first candle, these are third candle, right? When the wicks of our first and third candle are not touching each other, then we have fair value gap. So from the high of this to the high of this is our fair value, to the low of that, sorry, is our fair value gap. So this gap over here, because there is no price action apart from this particular body of this candle over here, right? So what happens is that we typically want to see something like this. We typically want to see something to the tune of this, right? Something like this. The candles will probably be crossing each other, right? Something like this. So something like this. Now we know that there's efficient price action delivery here, but in this case over here, you can clearly see that there's a gap in between the wicks of the first and the third candle. So this gap over here is called fair value gap, or FVG. So wherever you see FVG, it means fair value gap, right? So it's a 3-candle price action whereby the first and the third candle high and low doesn't meet. So the high in a buy side example, because this is an example in a buy side example. So in a buy side example, when the high of the first candle and the low of the third candle don't meet, the gap in between them is called fair value gap, right? So this is what an efficient price action looks like, while a fair value gap is an inefficient price action. So what's going to happen is that these market makers will want to return for fair valuation. I'm going to be explaining that in the next video. Our next video is going to be titled Premium Discount Array. So in the next video, I'm going to be discussing something that will throw more light on this fair valuation. So this FVG is called fair value gap. So what happens is that they will return, the market makers will reprice into this fair value gap and then trade to external range liquidity, right? So this is our fair value lookup. This is an example of efficient price action right. Now for sell side example, remember it's a 3 candle price action, right? So this is a sell side example. So now in this case, same thing. The first and the third candles, they are wicks or they are high and low. The gap in between. So let me use this. Good. So this is the first candle in this case, right? Because this one is being formed first. This is a sell side scenario. So this is the first candle in this case. So now this is the low of the first candle, and by definition, this is the high of the third candle. Now when the high and low, when there's a gap in between the high and the low, right, or the low and the high of the first and the third candle, then what do we have? A fair value gap. So that's a fair value gap right there. So now what will we expect? We'll expect that market makers will reprice into this. So market makers will reprice into this fair value gap and then continue trading to external range in the form of sell side liquidity. While over here, above here in the form of buy side liquidity, while below here in the form of sell side liquidity, right? So let me outline this. So we have sell side liquidity over here, and then what do we have over here? We have buy side liquidity. So does that make sense now? So this is what an efficient price action looks like. There's no gap, right? But here we have buy side liquidity above, and then we have fair value gap here in form of our internal range liquidity, and then price trades into it, goes out. Over here, sell side liquidity in the form, that's our external range liquidity in the form of sell side liquidity. Price trades into this fair value gap and then trades into sell side liquidity. So I'm just going to be explaining fair value gap and liquidity void, and then we'll jump into the charts before I come back to other block. So let's see this now. Now we know that this is a liquidity void, but liquidity voids could be rather generalistic in a sense. Like now, at which point will you know, okay, that we're meant to start reversing, right? So if you see over here, these are first candle, right over here. This first candle, this third candle. What do we have? There's a gap in between the high and the low. Now, mark it out. Mark out the gap between the high and the low. What do you have? Fair value gap in the form of internal range liquidity. What happens as soon as we trade into this fair value gap? We start going where? To external range liquidity. So let's mark this fair value gap, right? Now, over here again, what do you see here? In between the high and the low, another fair value gap. And then what happens when we trade into fair value gap? We go high, right? So let's just keep marking out these fair value gaps in between the high and the low. Fair value gap. What happens when we trade into this fair value gap? We go high. So do you see how now for this bullish scenario that we're giving an example with, we keep forming the higher highs and higher low, higher highs, higher low, right? We now form a kind of framework or a pattern in our head that this is how market operates. When we trade into external range, we return to these fair value gaps. Trade into external range, return to these fair value gaps, right? So that's the mode in which price moves. So you can see that liquidity void is rather generalistic, but fair value gap is more specific, right? Fair value gap is more specific. I will not be taking other blocks in this particular video because right now you don't need it, right? You don't need other blocks yet. So let's keep going. All right. So what do you see over here again? Fair value gap. So somebody might not have seen that, but do you see how precise the precision of this movement, right? So we took our liquidity here in the form of what? Buy side liquidity. Traded down. We've taken out liquidity over here, right, in the form of sell side liquidity. And what now happens? We trade into internal range. We now trade where? To external range again, right? What do we return back into? Internal range in the form of what? Fair value gap. Where do we now go to again? We go to external range. So of course we had a market structure shift right about here, right? But if we keep going, you'll see something over here again. When we shifted market structure now to the upside, we now have another fair value gap. We took our buy side liquidity. What do we have again? Fair value gap, right? Okay, we didn't return to this one, but when we took our liquidity here, what do we see here? We see another fair value gap. So we can keep going through the charts and you keep seeing this thing happening over and over and over again. Okay, so I think I'm just going to run you guys through the teaching of order block. But in this series, when I teach you the strategy I use for being profitable and my entry techniques, I'm not going to be using order blocks, but I'm going to teach you order block just so you know it and have it at the back of your mind, right? Even if you're not going to use it, I guess it could be an added confluence one day. So let's get into order blocks. So order blocks are the last candle before price breaks market structure in the opposite direction. So that means in the case of, so that's order blocks, right? It's order blocks. Let's just make it big. So let's move over here. In the case of a bullish order block, right? In the case of a bullish order block, it is typically, or it is the last down candle before price breaks market structure higher. That's a bullish order block. So that's a bullish order block, right? It is the last down candle before price breaks market structure higher. What's a bearish order block? For bearish order block, it is the last up candle before price breaks market structure lower. Right, so let's look at this. Let's illustrate. So assuming we're having price movements like this, right, to the downside, and then we now see something like this. Now what just happened over here? Typically, so since this is a market structure shift, that means we're breaking market structure higher, right? So typically there's a last down candle over here. Let me use red for the purpose of illustration. So typically there's a last down candle here. It could be the one that takes out liquidity, right? Or it could be just the last one here, right? So it is the last down candle before price breaks market structure higher. So typically you see that the next candle immediately after it, right, closes above its high. You see that the next candle after it closes above its high, right? And then we'll now see that from this point onward we have a series of upward movements. So this one over here, from the high of the candle to the low of the candle, is called our order block. This is called our order block. From the high to the low. What do I mean by high and low? You know that the high and low is formed by the wicks, right? So if there are wicks on this candle, then you make sure that you also include the wicks. The wicks are very important, right? So this is our order block. In this case, it's our bullish order block, or OB, right? So typically, what will we see? We'll see that price could return to this bullish order block after breaking market structure, right, and then going higher. And what's this? Internal range, because it does not break the low, because basically this is the low of our range. So it returns to this bullish order block and then go higher, right? So that's our bullish order block. What's our bearish order block? So when we have something like this, right, and then I guess chic structure to the downside, would typically have a last up candle, right? The last up candle over here before market structure shifts to the downside. Now this over here is what? Is our bearish order block. So let's put this in the same frame. So this is our bullish order block. It's the last down candle before price breaks market structure higher. Bearish order block is the last up candle, this one, before price breaks market structure lower. Those are order blocks. So let's jump into the charts and see those, shall we? So now, what do we have over here? This is the last down candle, right, that was traded through, right? So another way you could define order blocks is the last down candle before price traded through it higher, right? So since the candles, the series of candles after it closed above this last down candle, right, we can call this our order block. So if you mark it out, what do you see? Price returns into it, right, and trades higher. Now let's look for another one, shall we? This is our last down candle over here before price traded through higher or broke market structure shift higher. What happens? Now this is why I'm going to be focusing on fair value gap in these teachings, because you tend to have more consistency with fair value gaps. The strategy I use is solely focused on fair value gaps and not order blocks. So let's keep searching for order blocks, shall we? So over here too is the last up candle before this downward movement, and what do you see? What happens? Price rejected from the fair value gap and went. So order blocks are good, of course, but I find more consistency using fair value gaps. Now what do you see over here? These are order block, and the fair value gap just happen to be found within the order blocks. So here's a point worthy of noting. The most valid order blocks are order blocks that have a fair value gap attached to them. The most valid order blocks are order blocks that have a fair value gap attached to them. See this order block with a fair value gap, what happens? Right? So those are the most valid order blocks. Those are the most valid order blocks. Now, before I round up this teaching, I want to say that, of course, none of these things are important independently, which means you have to blend in a lot of things. You have to blend in market structure, right, on the higher time frame. You have to refine it to the lower time frame. So you have to understand your higher highs, your higher lows, what market structure is telling you. Are you bullish? Are you bearish? Then you can now know, okay, we're expecting a retracement into what? Internal range liquidity, right? Into a fair value gap perhaps, right? So you have to blend in a lot of these confluences. So now the question that is going on in your mind is probably something like this. You can be like, okay, we have a fair value gap here, and we also have a fair value gap over here, right? Or what happens in a scenario whereby I have 2 to 3 fair value gaps in my internal range? How do I know which one price will reject from and start going higher, or reject from and start going lower? Well, in the next teaching, we are going to be going over premium, discount, and equilibrium, and we are going to further refine this strategy of ours, and hopefully to give you more light. But before then, go into your charts, look for external range liquidity, look for internal range liquidity in the form of liquidity voids, fair value gaps, order blocks, understand how price moves, right? See the expansions, the retracements that we've talked about in the previous video. By all means, make sure you've understood the things we've talked about in the previous video, right? And if you don't understand a particular concept, of course, you can leave a comment down below, and at the end of the series, I'll try and link you to PDFs, right, and my social media where you can see some illustrations that I will post by them. So see you, and God bless.